Hi everybody, this is Mike Deschamps again, accounting instructor at MiraCosta College. And what I want to do in this last video that I'm preparing for you is go over a sample quiz that touches on some of the concepts that we just talked about in videos 1 and 2 to make sure that you have a pretty good understanding of the process. So let's dive into this first question. It says, during the closing process, asset and liability accounts are reset to zero for the next accounting period. Permanent accounts are closed to the retained earnings account. The retained earnings account is reset to zero to keep track of earnings for the next accounting period. And number D, income and expense accounts are closed to the retained earning accounts. Give you a minute to think about that. All right, now let's go through each of these possible solutions or answers one at a time. A, asset and liability accounts are closed to zero for the next accounting period. That can't be correct because asset and liability are permanent accounts, as we talked about, and their balances roll over to the next period. Number 2, permanent accounts are closed to the retained earnings account. No, and again going back to number 1, asset and liabilities are examples of permanent accounts, and their balances roll over, they don't close out. C, the retained earnings account is reset to zero to keep track of earnings for the next accounting period. No, that's not correct, because the retained earnings account is on the balance sheet, and we have defined all those accounts on the balance sheet as permanent accounts. So by process of elimination, for question number 1, the correct answer is D. Income and expense accounts are closed to the retained earnings account. All right, so let me just adjust this a little bit. And now I want to go to question number 2. And let me just expand the screen a little bit on that one. There we go. All right. It says, given the following adjusted trial balance. All right. Let's skip all that information, and the best task is to go right down here and find out what do they want me to do. And it says, after closing entries have been posted, what is the balance in the retained earnings account? So, what this question is going to require us to do is to go through all those steps that we just talked about in the previous video about the closing process and closing all those temporary accounts that we said were made up of 3 categories. Number 1, revenues and expenses, income statement accounts. Number 2, the contra revenue accounts, right, or contra sales accounts that we talked about that are also on the income statement account. And number 3, dividends, which is not on the income statement account, but like the contra accounts and like expenses, has both a debit and is going to be a reduction of retained earnings. All right. So we've got 4 choices for the answer, but in order to get there, we're going to have to work through some of the elements on this problem. So let me jump over here for a moment where I've kind of sketched out a process that we want to go through. All right, so the question, once again, is what is the balance in the retained earnings account? Well, we're going to work through our 4 steps here in order to get there. So number 1, it talks about closing the revenue account. And you may recall from that problem that there were 2 revenue accounts. We had sales revenue and interest revenue. And of course, because they're revenue accounts, they have a credit balance. To close them out, we must debit that account, right? And then we're going to credit income summary for that amount. The next thing we have to do, step 2, is close the expenses. And looking at the problem information, we had 3 expense accounts. We had bad debt expense of $18,250. We had salary expense of $58,580 and rent expense of $24,000 for a total debit side expenses of $100,830, which means to close it out, we're going to have to credit that account for $100,830 and then debit income summary for that. Now, as we talked about earlier, as I look at my credit and my debit to income summary, what it's telling me is that my revenues were greater than my expenses, such that I end up with a credit balance in income summary of $26,870. And now I have to close this with a debit, and what I'm going to do there is in step 3, closing income summary, I'm going to take that credit down here to retained earnings. Now, critically important, as we talked about previously. The information in the problem also told us that in the beginning there was an opening balance of retained earnings of $8,100, and we've recorded that here such that we're getting the correct ending balance of retained earnings for the period at this point, $34,970. Now, if we go back to a moment to the problem information, you will see that there's no dividends here. However, to make this a little bit more interesting, after we go over what the correct answer is, we're going to factor that in. So let's run back over here for a moment. And as I said, that based upon steps 1, 2, and 3, because the problem did not have any dividends, we have got an answer of $34,970 as the ending balance in the retained earnings account. And as we go back to the problem information, we see that there's an option there for $34,970, which means at the end of the day, that is our correct answer for this problem, $34,970. So again, we went through step 1, we closed out the revenue. We went through step 2, we closed out the expenses. And where do we close them to? We close them to income summary, as you can see up here. Then step 3 was to close retained earnings, which we see over here, which gave us the right answer. Now, let's add another layer to this problem. Let's just suppose that they actually paid a $4,000 dividend. All right. Now, dividends normally have a debit balance, which in this case would be that we would credit it. And so that debit would be over here to retained earnings. So if in fact they did pay a dividend of $4,000, the ending balance of retained earnings would be $30,970 and not $34,970. Now again, I put that in there just to show you what could happen if, but you're going to go by whatever the information of the problem gives you. And in this particular problem, as we looked at it, there was no dividends. All right, let's move on. So question number 3. Payments of expenses that will benefit future, current, and or future periods are classified as A, expenses, B, revenues, C, prepaid expenses, D, unearned revenues. All right. So this kind of goes back to one of those basic concepts when we're learning our accounts in financial accounting, that when we pay something ahead of time, all right, not an expense that's going to be incurred in this period, but later in this period or a future period, that is called what? It is called a prepaid expense. And so, as we can see here, payments of expenses that will benefit future periods will always be defined as a prepaid expense. Next question we want to look at. Question number 4. When a magazine sells a 1-year subscription to customers, it's an example of A, an unearned revenue, B, a prepaid expense, C, an accrued expense, D, an accrued revenue. All right. Well, remember when we talked about adjusting journal entries, we had this concept called accruals and deferrals. And when we talk about deferrals, those are things that are put off. For example, if we go back up here to this question, which talked about prepaid expenses, that's a deferral, right? In other words, we're going to defer that benefit until the future period, even though we're paying the expense right now. And when we talk about this particular one, we're also talking about a deferral. And in this case, it's a deferred revenue, which is an unearned revenue. So in that case, that's going to be the correct answer, that payments of expenses that will benefit current and future periods are when a magazine sells a 1-year subscription to a customer, it is an example of an unearned revenue. All right, let's continue. So now we go down here and it says, use the following information to answer questions 5 and 6. So it says Fusco Company had the following transactions during 2019. Sales of $6,500 on account, basically accounts receivable. Collected $2,000 for services to be performed in 2020. Paid $625 cash in salaries. and then finally purchased airline tickets for $375 in December of 2019 for a trip to take place in 2020. So the first question asks us, what is Fusco's net income under the accrual basis of accounting? Well, let's jump over here to our solution set. And the first thing that we're going to do is to remember that since this is accrual accounting, and let's go back over some of that information that we saw there. All right. Collected $2,000 for services to be performed in 2020. All right. So you're collecting that money for a benefit that you're not going to extend to somebody for a future period. All right. Can you call that cash right now? No, you can't. All right. You can't call that income, right? Because you haven't done anything to earn it. And we said that one of the key things about recognizing income is that you must have finalized the performance of it to some degree. You know, and I say some degree because when you talk about construction, you know, we talk about that you have certain periods where you can recognize income if you've performed up to a certain period. So in this case, it's just blanket services to be performed in 2020. Well, you know, I can't call that income right now. All right. Paid $625 in cash for airline tickets. Okay. Yeah, that's for this period. But what about this one? Purchased airline tickets for $375 in December for a trip to take place in 2020. All right. So think about this one. You know, is that an expense for this period? No. All right. Because we haven't recognized, it hasn't finalized the process of by actually utilizing it. All right. So basically, that is not an expense. That's a prepaid asset. All right. And we're not going to recognize this expense till the following period. So we're not going to count at this right now under the accrual method, you know, for determining the amount of income. And over here, we collected the $2,000 for services to be performed in 2020. You know, we can't recognizing that right now because we haven't completed the process. So that's what? Unearned revenue. That is a liability. And so since the question asked us for number 5, what is Fusco's net income under the accrual basis of accounting? We have to go by what was income for the period, the $6,500, all right? That was, even though it wasn't in cash, it was a receivable, and on the accrual basis, we can recognize it. We paid out the $625 for salaries, all right? That is going to be an expense for this period. And so under the accrual method, income for the period is going to be $5,875 by my calculation. And when we look at the answer sheet, it's $5,875. All right. Let's look at one more question on this related to this piece of information. What is Fusco's 2019 net income under the cash basis of accounting? All right. So all of a sudden, things that we couldn't use before, we can use in calculating it for that basis. All right. So when we talk about net income under the cash basis of accounting, all right, we collected $2,000 for services, all right. We paid $625 cash for salaries. We paid $375 for airline tickets. So under that basis, it kind of looks like that our net income under the cash basis is $1,000. We go to our solution sheet and we can see that it is going to be that. $1,000. All right, let's continue with a couple of more questions. All right, and the next one is going to be this one right here. Which of the following is true about adjusting entries? Adjusting entries can sometimes involve the cash account. Adjusting entries only involve balance sheet accounts. Adjusting entries only involve income statement accounts. Or adjusting entries always involve a balance sheet account and an income statement account. And the correct answer here is going to be D. That adjusting entries always involve a balance sheet account and an income statement account. And when we talk about the balance sheet, it's going to be all balance sheet accounts except for cash. All right. So, and remember, when you look at these, you're looking for what is the best, the most complete right answer that is going to get me where I need to be. So let's look at just one more question here in our review. Which of the following is true? Inventory is usually reported as a current asset on the balance sheet. B, using FIFO, the first units purchased are assumed to be the ending inventory at year end. No, because FIFO means first in, first out. So it's the last items purchased that are going to be ending inventory at year end. Number C, during periods of rising prices, companies are required to use FIFO as the inventory costing assumption. No, actually it's LIFO. And D, under a perpetual inventory system, when inventory is purchased, the company records cost of goods sold for the amount of the inventory purchased. No, they would record cost of goods sold when the amount of inventory is sold, not purchased. When we purchase it, it goes under the inventory account. All right, so the correct answer is A. Inventory is usually reported as a current asset on the balance sheet. All right, I thought that was it, but I think I have one more question for you. Oh, I do. And we don't want to miss this because we want you to score a passing grade on the exam. So, the employees of Nixon Company have worked the last 2 weeks of 2019, but the employees' wages have not been paid or recorded as of December 31st, 2019. The adjusting entry that Nixon should make for these unpaid wages on December 31st, 2019 is. Now, let me just review something real quickly. I said a moment ago that when we talk about adjusting entries, we divide them into two categories. We have deferrals and accruals. All right, we have deferred revenues and accrued revenues. We have deferred expenses and accrued expenses. All right, in this case, this is an example of an accrual. All right, of an accrued liability that also on the other side of that is going to be an expense. All right, so it says debit to wage expense and credit to cash for A. No, because we haven't paid them yet. There is no cash going to be involved here. A debit to wage expense and a credit to wages payable. All right, that sounds reasonable. All right, or is it? Yeah, I think that sounds reasonable. Number C, debit to wages payable and credit to wage expense. Be careful. Notice that B and C is trying to confuse you by having very similar language, but they mean very different things. Number D, no entry is required until the employee is paid next period. Well, that really doesn't sound like accounting, does it? All right, so let's go over here to the answer sheet, and the correct answer is the accrual adjusting entry. The accrued expense adjusting entry is a debit to wage expense and a credit to wages payable. We're recognizing with this that the wage expense is for this period, and also recognizing that we have a liability to those workers for these wages, even though we're not going to pay them till the next period, which when we pay them next period, that's when we're going to do an adjusting reversing entry to record that. I hope this quiz has given you some idea of some of the questions that you might see in the CAT exam. Obviously, the questions aren't going to look exactly like these, but the idea is that I've given you some concepts to look at that have a high probability of being tested, and as long as you have a really good idea of what the concept really reflects, then how it's worded, if they change things around a little bit, is really not going to affect you. Don't get tied up in the verbiage. Be confident that if you understand the concept, you'll be able to find the right answer that you have there. So this is my last video for you in terms of the CAT exam. I wish you the best of luck. I know you'll do well. Just spend a little time reviewing and you'll be fine. Take care.